The U.S. stock market ended its worst week since March 2020, the beginning of the pandemic. On Friday, the numbers were mixed. The Dow Jones slipped about 40 points, while the Nasdaq gained more than 150 points, and the S&P 500 rose just over 8 points for the day. That index fell nearly 6% for the week, recording its single largest drop in more than 2 years. All three finished the week with sharp losses. Investors are worried the Federal Reserve's aggressive interest rate hikes to control a 40-year high inflation rate could tip the economy into a recession. For more, I'm joined by John Quelch. He's the dean of Miami Herbert Business School at the University of Miami. Thanks for being with us. It's been an extremely volatile week for the markets, to say the least. Have we hit the bottom?
I think most people would estimate that we have not yet hit the bottom. Remember that we have given up the gains that were made since the end of 2021. So it's not as though investors are losing money that they held in their 401ks pre-pandemic. What we have here is a big division of opinion between those who think the Fed's strategy will work, that the Fed will tame inflation, and that interest rates will be held within the boundaries that the Fed is forecasting. But there's another school of thought that says that the Fed is still late to the game, that there's a lot of inflation in the pipeline, and that much bolder measures will be needed. And the higher the interest rates go, Catherine, of course, that means costs of borrowing to business go up, and the attractiveness of investments and therefore the value of stocks goes down.
Well, that's right. So what is it going to take and how long to tame inflation?
Well, the Fed has split the difference between the doves who were arguing for 50 basis points and the hawks who were arguing for 100. So they've taken the path of saying 75 basis points. But more importantly, they've indicated that the next round of announcement is likely to include another 75 basis points. And then they're hoping to revert to 25 basis point, in other words, quarter point increases thereafter. The question is whether or not that will be enough to tame the beast. But the good thing about it is that they have made this forecast. And so, in a sense, that forecast for additional interest rates is already baked into the stock market valuation.
Well, let's talk a little bit about the timing and the timeline here. Could the midterm elections be a turning point for the markets?
Well, usually the midterm elections have some bearing on the markets, and in the second half of a first term, there's usually not a good result for investors. But you know, those connections between politics and economics are pretty uneven and not well established. And so I'm not so sure that that's necessarily going to have a big impact. If, for example, however, the Republicans were to gain the House, that would pretty much put a big blanket on top of additional spending programs that the current administration might wish to push through. And that would probably be well received by the stock market.
You mentioned the Fed is aggressively raising rates, and as you know, aggressive moves in the markets can have unexpected consequences. What explains, in your view, this previous lack of action by the Fed?
Well, the Fed took a long time to determine that the inflation that it was witnessing was not temporary or transitional. And there were many economists who called out the Fed a year and a half or more ago with respect to the inflation trend that they saw in the numbers, and they saw growing in strength. And it's unfortunate that the Fed is now having to play catch up. But of course, the Fed does desperately want to avoid a recession, and they're almost more interested in doing that, or have been up to now, than they have been in curtailing inflation. But now that inflation has got out of control, there's no question that they have to get that in shape. And it's going to take several additional interest rate moves, in my opinion, before we see 3 or 4 consecutive months of lower inflation rates. In other words, in rates that are below the 8.6% that we saw most recently.
And that brings me to the final question. What are the indicators that tell you a recession may be avoidable here?
I think the most important attribute of the U.S. economy versus other economies is that the U.S. has a tremendous reservoir of innovation capacity and an appetite for innovation. And while we are seeing, obviously, the tech sector hit extremely hard in the current downturn in stock prices, the fact is that the tech sector and growth in that sector is likely to play a big part in the emergence of the U.S. from any risk of recession.
John Quelch, thank you.
Thank you.